Hey everybody, it's the end of it's a new quarter now, so it's time for end of quarter update on how everything went with the S&P 500 and TSP over the second quarter. All right, so I'm going to do a presentation on a number of slides here, give you some data here to look at, and give you kind of a general idea of how things did, and how the index and TSP both did, or what's going on economically as well, and what what to possibly expect over the next quarter. All right, so keep watching, and we'll have some stuff for you. Okay, let's start off with my S&P 500 price targets and all that, and give you a general idea of what the total S&P 500 market cap is, stock and bond ratios, all that kind of stuff. All right, so we'll start off with the total market cap of the index is now up to $41 trillion. It's getting up there. All right, total trailing 12-month earnings is 32.86. Total next 12-month earnings is 39.31. That translates to about a 19.65% gain expected over the next year. Then I had to make adjustments here to try to keep my price targets in the right neighborhood of where the market is expecting or going for, my opinion. We'll start with current value. I have it at 40.10. So with no earnings growth at all, I think the S&P would be at 40.10. But with the future growth factored in, the 19.65%, that means it'll be up to about 4,800 next year. That's basically in a no growth environment, which means my 12 if this growth projection stays at 19, almost 20%, which I don't think it will, but we can at least project. At that same growth rate, we could expect the S&P 500 itself, the price, to get up to over 5250, in the 5250 to 5300 range by this time next year. Now, right now, for those of you guys who are short-term traders, who are in my swing trader group, the swing out target right now is 44.05. It's a little bit higher than where we're at right now, but not too much higher. I think the index closed at almost just a little bit below 4,300. We'll get to that slide pretty soon here, and I think it's up above 4,300 now. But I didn't look that closely. All right, swing in target 42.50. So right now we're kind of in that window where I wouldn't be a buyer necessarily, but wouldn't be a seller either. But on the other hand, it's the end of the quarter, and we have more slew of earnings coming in later this month in July. So expect these numbers to go to climb over the before long. This week, I mean, we'll cover this more on another slide, but just expect that these numbers are going to probably get pretty active with changing in one direction or another. More likely up, but generally, yeah, it's going to move a fair amount, I assume, when later on this month. Okay, as you see, the BEER ratio right now, which is the bond equity earnings ratio, is favoring stocks by 95% to 5% ratio. So those of you guys who want some, you want to be a little bit more on the pragmatic side, I guess, or a little more conservative, I recommend you follow this. That way you're more heavily exposed to stocks when it's a good time to be in stocks, and then when there's a more legit concern about, or not so much a concern, but when bonds are a better investment opportunity than they are right now versus stocks as well. Where your money is just better invested in bonds, or progressively better, your money will shift gradually, like in 5% increments from bonds, from stocks to bonds, as the bull market gets older. So right now it's still very strongly stocks. That could change later this quarter, but I don't expect it to change by much. I don't tend to see it until we see a more pronounced increase in bond yields. I don't expect this to change anytime soon by a very strong amount. All right, so for the trailing PE, a lot of people are going to say this is up there. Just by my own numbers, I have 30.45 trailing PE and then 25.45 forward PE. It's getting up high enough where it will concern some of you guys who look at PE ratios. I don't tend to look at PE very much. I just put that in there for just to kind of give you a ballpark estimate based on my own numbers, where I think the index is at. All right, looking ahead, actually both in the rear view window mirror and looking ahead over the next 4 quarters. This gives us a projection of what to expect. That number, remember that 40-10 number I talked about in the previous slide? It's right here. This is where we're at now. We had 52% growth over the last quarter and 11.5% over the last year. These are very healthy numbers. All right, so next quarter, we're going to have some more strong growth, over 50% year-over-year growth for the quarter. That 40-10 number is expected to go up over 300 points this quarter alone. So just this quarter, even if the growth slows down, like it slows down even just 5%, as long as the companies as a whole meet or beat expectations, we're going to see that number climb up to about 4,400, and with the 5% upward projection, we're still looking at a higher number than we're at now by the end of third quarter. All right, looking ahead 2 quarters, it's going to jump another 200 plus points, or we're expecting at least 200 plus points more in fourth quarter of 2021, and then about 160 point increase in first quarter of 2022, and it'll slow down about 30 point increase in second quarter of 2022. When it slows down on the back end there, I do have concern that it could slow down the growth rate of stocks as well as a whole, but we'll have to we'll get a better idea once all the companies start to report earnings this quarter, and let us know. Give us a better projection, because I need the 5 quarter ahead data that I don't look at to roll into this 4 quarter ahead neighborhood, and then for this 4 quarter part to push up into the third quarter ahead area. So it gradually blends right over from one quarter to the next one, and then it'll go from there to there, there to there. Yeah, just as the quarter progresses. So it's not like we're going to see like just some like really quick change, unless I just do one more presentation at the end of third quarter. But I tend to keep you guys updated as the quarter progresses when it gets in the busy part of earnings season. So expect that there'll be more updates, and you'll see this progressively change. For those of you guys who invest outside of TSP, whether it be in an IRA account or a regular taxable brokerage accounts or whatever else, if you have the option to invest in different sectors or in specific companies, whatever, that's what this slide is for, to help to give you ideas on where you might want to focus your attention if you're putting money into something. So right now, still seeing the strongest growth expectation from the energy sector. As a whole, they're still a little bit below, just a little bit in the red. Basically a little bit underwater on their trailing 12-month earnings, but it's expected to increase very strongly over the next year. The very strong percentage growth there is, I wouldn't really expect that, but that's what happens when you have a very small number to compare versus, so I've got about a 65 point change there, whereas with industrials, this is about 140, coming up on a 150 point change there. But there are more companies in that sector as well, and you have a larger number to compare against. So, and even by that rate, 40.8% is very strong growth to expect from the industrial sector, and 40.5% from the consumer discretionary sector is also extremely good. Materials is at 26.4%. I usually expect materials and energy sectors to to follow the leader. Whatever so goes, as the energy sector goes, so does material sector, generally speaking. So these four sectors as a whole are definitely the ones I would focus my attention on if it was me putting my money into something. The information technology sector is also worth considering, 16.4% growth. So that's worth considering as well, but I think mainly if you focus on energy, industrials, and consumer discretionaries, and if you want help with specific companies within those sectors, that can help narrow that down too. I don't have the I'm not looking at as much of a microeconomic view on this, so or narrowing it down more to a more specific area. This is looking more broadly at the 11 different industrial sectors that represent the S&P 500, and it's just meant to give you a just general idea what to expect from each different sector. So if you have company in some of these other sectors, real estate, that's kind of an oddball one. I can't really work with them very much because I get my data from TD Ameritrade, and real estate companies, they usually report earnings in terms of funds from operations, and everybody else reports their earnings in terms of earnings per share, and it's not really a good comparison. And then ever since Schwab took over TD Ameritrade, I don't really see any analyst estimates for real estate companies. In fact, a lot of times I even have to go to other websites to figure out information, and I don't have good forward info to work with. So they're going to kind of disrupt the overall flow of the rest of the index, unfortunately. If you ever have questions about the real estate sector, though, Scotty Cox is always a good person to talk to about that. If you want insights into that, he's a very knowledgeable person who's been in our group for quite a while, and he has a lot of interest in the real estate investments, or the REITs as we call them, real estate investment trusts. Okay, so looking at the industrial sector I talked about earlier there, just kind of give you an idea where the strong growth is. It looks like it's going to be in transportation. So we got a negative number there, but really it should be positive because if you look at the trailing 12 versus the forward 12, very strongly positive on that. And then breaking down the transportation, we can look at this as well. Airlines looks like they're going to still be in the hole over the next year, but it's a very strong improvement. Whereas air freight and logistics and road and rail, or particularly air freight and logistics, doesn't look like it's going to be that strong. Not quite as strong. It's single-digit growth. It's not in an area that I would particularly have an interest in. Personally, if I'm going to put my money into something, I want to see something that's going to have double-digit growth, preferably. And then I'll look elsewhere when whenever this metric changes. So the road and rail stocks, if you're wanting to look a little bit more narrow, like the trucking companies or Burlington Northern Santa Fe or Union Pacific or Kansas City Southern, any of those rail companies, those might be worth considering as well. 26% growth as a whole across that sector, that industry is a very healthy amount, and that'll get you, that should hopefully get you better than stock index level performance if you're focusing your money in these particular areas that were discussed here. Okay, as at the end of the quarter, we had 502 of the 505 S&P 500 stocks factored into this. Now, there are only 500 companies, but 5 of those companies have 2 share classes, both of which are in the index. So that's why a lot of times you'll see more than 500. Also, there was a company in there that I think reported earnings twice in that same quarter. They were for different fiscal quarters for themselves, but I go by when they actually announced their updates, and I don't really care what fiscal quarter it is. I'm just looking at the overall what's the latest data we have for that particular range of dates. As we have here, though, 53% year-over-year performance. That's the strongest I've seen ever since I've been recording this data back in 2015. That's actually almost double what we saw in third quarter of 2020, and still a good 20% higher than fourth quarter of 2018. So extremely strong. But also keep in mind that it had a very easy standard to compare against, so that's kind of to be expected. Now, as far as positive breadth, it's not as strong as we've seen in the past, but it's still very healthy. 392 of the 502 stocks, or about 78% of the index, reported positive growth. As you see here, throughout 2018, it was pretty much higher all year, the entire year. Just a tad lower in first quarter of 2018, but it was at higher levels of positive breadth throughout the second, third, and fourth quarters. Otherwise, outside of that, this is a very strong quarter here still. Very strong breadth, and that's always a good indicator for the broader economy. Okay, so 99.4% of the index got accounted for that quarter, or in second quarter. As always, whenever you have companies reporting near the beginning or end of a quarter, sometimes the ones that are reporting at the beginning of the quarter advance their announcement to the end of the previous quarter. So they ended up sometimes doing two announcements in that same quarter that I'm accounting for. And sometimes companies that are at the tail end of the quarter might push back their announcement date to the first or second week of the new quarter. So that's why a lot of times you'll see some variability here with how many companies actually report here on this column here. All right, looking at the 5 or so weeks ahead, don't have any companies at all expected to report earnings updates this coming week. And then as you see, it's going to get progressively busier. Next week, the week of 12 through 16 July, I'm looking at 22 possible companies reporting updates. And then the following week, 89. So it's going to pick up pretty fast there. 4-time increase there. And then it's going to double, more than double from there to 184 during the last week of July. That's going to be a busy one, really hard to keep up with. And you'll see more rapid changes there. Actually, even right here in 20 July, it looks like there's going to be a pretty good size increase expected in my my current value number. You know, the number that doesn't factor in any future growth expectations. We're looking at a good 100 points right there just in that week alone. And this week here, we got 50, 70, about another 100 or so points here as well. So about 200 point change in my my target price there with the current value, or basically trailing earnings only based price target. Good 200 points over what it is right now, which was 40.10. So that's probably going to put it up to 40.20, 4,200. I mean, not even including a little bit here. And even more, over 100 more companies reporting on the first week of August. So last week of July, first week of August, is going to be very, very busy. And expect a little bit more activity there. Now, when there's more earnings activity, you're going to see more movement out of the index too, usually. Moving on to bond yields. Again, this is a very noisy chart table, but the idea here is to just give you an idea, just a visual on trends. If you look from one column to another, the 1 month yield usually tends to be a lot more reactive and in line with what the Fed rate policy is. So when Fed rate policy has been at or near 0%, what you're seeing there is at or near 0%, 0 or even 1 or 2 basis points or so. But it's starting to trend upward as of mid-June, up to about 5%. So that tells you that the bond market is betting on they're expecting that the Fed might raise the interest rate to about 0.25% a little bit sooner. It doesn't look like they're expecting it to happen in the next quarter, and even the Fed themselves have said they don't really expect it to happen until at least next year. I have my own opinions on that. I think I think they really should be a little bit more hawkish on that because of the inflation concerns. We'll talk more later. Kind of brush over that a little bit later in this presentation, but probably go into more detail on that in a different presentation. But yeah, these the short-term yields are trending upward a little bit, and not much to really make any real difference, but it's noticeable. 2-year and 3-year also going up a little bit. Now, as you get to the longer-term yields, all these blue-gray colored ones are the ones that affect the G fund, what its growth rate is. Generally, the 10-year yield is what you can expect, more or less what the 10 years growth rate to be per year. So it's, if you look here, and I'm going to show you on another chart too, that the 10-year Treasury yield, Treasury note yield has gone down a little bit from 163 about mid-May to 145 now. 30-year yield has also gone down a little bit, so that's probably a good thing for you guys who are buying homes or refinancing homes. Now, the bond yield curves, that's something I always watch for too. The comparison between the 2-year and 10-year yields, that's one that I tend to look at most. That was at 1.47% difference in mid-May, and that's dropped to about 120. So as I always like to remind people, when that yield curve there inverts, where it turns negative, basically where the 2-year yield is higher than the 10-year yield, very commonly about 9 to 24 months after that takes place, you usually will see a bear market begin. That's not always the case, and there's more to it. I mean, if stock prices and earnings continue to grow even after they invert, but it starts to get the snowball rolling, at least, where it'll start slowing down growth to a point where it could flatten out and even turn south. So that's what we're mainly watching for with that. As long as that's positive, the 2-year, 10-year is positive, and these other yields there too, the 2-year versus 5 and the 3 versus 5. As long as everything's positive, generally you should expect the trend to stay positive as well with stock prices. Okay, this is looking at the 10-year yield, actually visually what it's done since last year. As you see here, I got back in July 2020 over here. You saw it spiked up in February and topped out here at 1.765 neighborhood. And it's generally trending downward ever since. This looks like it was late March. Now, late March, the Treasury bond yields are generally trending downward a little bit. Okay. Normally, when you see that, that means that bond investors are probably buying up more bonds, which does make them perform a little bit better in the short term. But as the yield drops, the less attractive that's going to look as a long-term investment. So generally, it's in the short term, F fund is probably, this indicates that F fund is probably performing a little bit better, definitely better than what it was probably doing here. Now F fund it covers a lot of different bonds. It's not just Treasury notes. It also affects. It has municipal bonds, corporate bonds, pretty much any kind of bond in there, and at varying lengths, maturity lengths, whatever. So, whereas TNX, or the 10-year Treasury note, literally just does that, the 10-year Treasury note, government bond, or federal government bond, whatever. All right, so yeah, as the yield trends downward, though, like I say, expect bonds to become less attractive. They're going to probably taper off in prices, or at least slow down more if the bond yield keeps dropping, which is actually going to make stocks look even more attractive. And that's probably why my beer ratio switched from 90% stocks, 10% bonds, back up to 95% and 5 as a result of this update. Looking at the bond yield curve, I talked about inversion of the yield curve. What we're looking for, the short-term bonds, when they get higher in yield than the long-term bonds, what you tend to see is like a wave, not exactly a sine wave, but it tends to come up like this and then drop down in the middle and then come back up like that. Um, when the yield curve inverts, you tend to see more up and then down and then back up, but not quite as far up on the right side of the chart as you will on the left. So it still looks very much early bull market type of chart is what I would call this. This doesn't look like this is anything close to what I would expect from a market that's getting ready to go into a bear market. And there's plenty of other data here to support that. This is a bull market, not a bear market. Looking at the TSP share prices over the last couple of months, between May 14 and 30 June, about a month and a half. Just mainly looking at the colors here to get a general idea of what's performing well and what's not. Uh, from day to day, as you see here, it's kind of been a mix between F, C, and S, I guess. iFund had one good day in there, but it's generally not been doing so well over the last couple of weeks. Over the month, F Fund, the S Fund was the top performer by more than 1% over C Fund. And iFund has gone south again. Why, I don't know, because their manufacturing data suggests still strong growth. So I don't really know what's going on there. And or it could be a U.S. dollar index, I guess, getting strength or something, which I haven't even looked at, but I believe it's been trending upward. So the dollar could be gaining strength in relation to the countries that are part of the iFund. So I'm just speculating that could be a factor in there. I don't know for sure, though. But as of right now, over the last couple of weeks, it definitely looks like iFund is not a good place to be. Okay, over the last year, looked like around the end of the first week of June, it kind of flipped where C Fund was the strong performer to now where S Fund is generally be the stronger performer. I've thought about changing my max risk, max reward suggestion in the main group for you guys to 100% S Fund, but with what's going on recently here, C Fund has been outperforming S the last 3 days. It's making me balk at considering doing that. But otherwise, yeah, I was actually putting some thought into changing that suggestion back to 100% S Fund. And speaking of, my own personal position is also at 100% S. I swing mainly between C and S, and I'll have another chart here coming up really soon that'll kind of explain that more and when to possibly expect me to make another move if you're in the swing trader group. All right, looking at the index price versus 12-month earnings. The S&P ended June 30th at 42.9750. So nice healthy number there, almost 4,300. It's still below what my price target or my short-term price target is, but it's not that far off. And you see my 12-month earnings there, 40.10. Price relative to earnings is 7.17% change between the two, which implies about a 14% growth rate expectation is what the market seems to be pricing in. Looking at that same data on a chart, this kind of gives you an idea here. When the blue line is above the orange line, then basically the market is generally expecting growth. When the blue line drops below the orange line, like it did over here, it's generally expecting a drop. But that doesn't always happen. As you see here, it dropped below there, and it maybe flattened out around the 3,000 or so level after that, but it didn't actually drop. And same here, when it came up here, what was that? The second or third quarter of 2019, it looks like, and it dropped through the end of 2019. The price actually dropped, which means that the market's expecting the earnings to drop as well. But they didn't really drop. I mean, they dropped a slight bit here in this area here in between second and it looks like first and second quarter of 2020, but it wasn't much of a drop at all. It basically means that market priced in an exaggerated drop here. They expected a lot more. There was more Chicken Little activity there. They expected the price to drop, the earnings to drop more than they really did drop. But you see they quickly reacted and came back up a couple quarters later, and it's been remaining above the orange line from there. So orders in here expect to see continued growth over the next quarters. It could slow down. I believe it could very well slow down a little bit, but all I mean by that is that don't expect this kind of growth rate right here. Expect something a little bit more modest or reasonable, like perhaps something like you see right here. That's all I mean by that. It's still probably going to outperform bonds, so generally stocks is still a better place to be. Okay, over the last quarter, we had 3 constituent changes in the S&P 500. See here, PTC Incorporated was added. That's an information technology application software company. And they replaced Varian Medical Systems because Varian Medical Systems was acquired by Siemens Healthineers AG. And the other 2 additions were both in the biopharm group. Healthcare. One of them is a life science tools and services company, and the other one's a pharmacy company. Charles River Laboratories International and Organon and Company. I see these were also because of M&A activity, or merger and acquisition activity, if you will. Charles River Laboratories replaced Fleur Systems, which was acquired by Teledyne Technologies. And then Organon joined the index just last month after Merck and Company spun off Organon itself. And then Merck will remain in the index. Now, basically, Merck stayed large enough to stay in the index, and then their spun-off company is also large enough to be in the index. And because the spun-off company, Organon, is more of a large-cap company, and HollyFrontier was near the bottom end of the market cap space, and it was more representative of the mid-cap market space and not large. HollyFrontier got bumped out of the index by this merger, or by this not merger, but this spinoff. On a typical year, you tend to see up to 2 dozen constituent changes over the course of the year. So three constituent changes in the quarter is actually, I would call, below average. I'd normally expect to see about 5 or 6 changes every quarter, but it's definitely slowed down a little bit more over the last year. But just so you know, any company that does go bankrupt, they don't stay in the index long. Actually, they get removed very quickly by Standard & Poor's and replaced with a different company. So you don't have to worry about your stock index fund investments dropping to 0 value. That just won't happen. All right, for those of you guys who follow me in the Swing Trader group, so what this chart does is represent, I reset this to 0 on the day that I did my IFT back in March. I've not made any moves ever since. I wanted to move right here, but didn't because I was concerned that it was too early in the quarter. Turned out it would have been a great move, but I didn't. It would have been a huge move. I could have outperformed by a good 10% had I moved over to C Fund right here at that 3.71 point and ended up at 7.48 in the negative there. So what that says is if I had moved over to C right there, between here and there, I would have outperformed S Fund by a good 11% by the time it came down here to the bottom. And then right here would have been a good day to move from C to S. Now, I am currently in S Fund, and what I'm doing here is waiting for the blue line to climb back above the red line. It's working its way up in that direction now, but again, the last few days have been trending in the wrong direction. But we'll see how the next couple weeks go. Hopefully, we'll see the blue line continue to trend upward and get above the red line somewhere, maybe at least a good, maybe a couple of percent before I decide to make my next move back over to 100% C Fund. Okay, I do have other economic data I wanted to include in there, but I don't want to have this presentation be excessively long. And I think it'd be better to just focus this on specifically the S&P 500 and the TSP, what's going on with them. Generally, though, expecting strong growth still. Economic reports are still looking upward as a whole. I do have the data for a couple of those monthly reports that I always look at, but I ended up choosing not to add them to this presentation. I might do it as a different one It doesn't tend to get as much interest from you guys as what I presented here. So there are a lot of times I just don't even post it. I may go and post it tomorrow or something and give you guys an idea. As I really do think it's important for you guys to look at that economic data that I look at each month. So hopefully you guys will take a little bit more of an interest in it, although I doubt you will. So we'll see. Anyway, okay, to summarize this, expect more growth over the next year, but I would not be surprised if the quarter-over-quarter growth trend starts to flatten out a little bit more and get more into the single, maybe could be 5%, 10%, whatever annual growth figure. We'll look more at the quarterly figures and all that too, and as it progresses, and they say stocks are still the more preferred place to be right now. Yeah, they're more highly likely to get you more out of your invested money than bonds. So just stick with the plan there. Stay with stock funds. If you're in the main group, keep following Deb or any of my suggestions in the main announcement post. Just use hashtag main announcement. Search the group for hashtag main announcement. It'll help you find that particular post. Also, if you need help finding info on Deb's current position, it's also in that main announcement post as well as in the events section. Do not ask what our position is or what our recommendations are. You will get muted, and you will get asked to do your homework and find the answer and give it to one of us, particularly to me, in order to get yourself unmuted. So don't ask that question. I'm not trying to be a jerk, but we have our own sanity. We don't want to get asked 100,000 times every single day about what's the current recommendation or position. We have the information very easy to find for you for a reason. You just have to get familiar with the group and know where to find it and use those references regularly. Okay, that's all I have for today. I hope you guys enjoyed. Got some good information out of this. Maybe some of you guys who are on the little bit more fearful side, hopefully it might have assuaged any of your concerns or anything like that. And we'll have some more information for you guys as the quarter progresses. All right. Thanks a lot. We'll see you guys later.